right. Good morning. Good morning. Good morning. 1 second. Let me make sure my settings are together. My name is Dwayne Williams, and today, what we're going to be doing is just talking about the LLC and making sure that everyone understands it, and hopefully put people in the right position to understand some of the things that they need to do. So, um, please, if you have any questions, by all means, make sure that you ask your questions, type them in the comments, and we are going to get started here shortly. So if you can actually hear me, please just type a what in the comments or just anything if you can hear me. Again, if you can hear me, just go ahead and type one in the comment, please. Okay, let me try to get my microphone to work. Testing, testing, testing. 1, 2, 3, 4. Another request. If you can hear me speaking, please just type one in the comments. Oh, okay. Hey, James. Hey, Jamin, how you doing? So you can hear me on that side. Great. All right. I'm gonna go ahead and get started. Thank you, thank you, thank you, thank you. Hey, Jay. All right. Now I feel comfortable. We can get this party started. All right. Good morning, everybody. My name is Dwayne Williams. I sit in the CEO chair of Mac Enterprise Consulting, which is a full service business consulting firm. And my job is to help people start businesses, restructure businesses, and more importantly, help educate people on what it means to run a business and how to actually get your business on what I call the journey to success. And today is a day where I'm asking, from a very humble place that you try to have an open mind about this conversation, because the LLC is such a common thing. Everybody and their mama tell you that as soon as you want to start a business, go get an LLC. And what's interesting is nobody even asked you why you want to start a business. What is the plan for over the next 3 to 5 years? And what I plan to do is just try to give you some education for you, right? And I don't want to give you anything that I heard. I want to be able to show you from a IRS perspective, from a tax perspective, on what it means to have an LLC, and hopefully it will give you some insight on whatever your overall goals are. What is the best structure for you? All right. So for some people, this might be a little bit repetitive from some of the other lives I've done, but just kind of bear with me. And what I've noticed is I'm using an app called StreamYard. So I'm trying to stream across Facebook, YouTube, and Instagram all at the same time. So by all means, please type your questions in the comments. For those that are on Instagram, unfortunately, I do not have Instagram in a place where I can see if you're typing questions. So I'm gonna try to log on to Instagram from my phone to see if I can kind of see some of the questions that are being asked. If I'm not answering your questions fast enough, feel free to follow me on YouTube or Facebook, and you can kind of come tap those questions. Ask those questions there. So here we go. We're gonna go ahead and get started. So first and foremost, whenever you're opening a business, right, you want to make sure that you understand what it means to have an LLC. So I'm going to actually pull up the business structures on the IRS's website. And I am going to go down to where it says LLC. And there's a couple different things that I want to go ahead and get out the way. And I want you all, good morning. And I want you all to understand this is directly from the IRS's website. Number one, the first thing is a limited liability company is a structure allowed by state statute. And I'm going to stop right there. That means that from a federal government perspective, the LLC is not even recognized. That's something that you need to understand. And I'm going to explain why that's important here shortly. Number two, the other thing that you need to understand is owners of an LLC are called members. Now, I don't care what school you graduated from. I don't care what city you're in. English class when you were in high school was very important because they also taught you the meaning of punctuation. They also taught you the meaning of what does it mean to have something as a singular or plural word. And when the IRS says owners, as an S at the end of that sentence, that means plural. Are called of an LLC are called members. That's another S. Automatically, what the IRS is trying to get you to understand. No, they didn't shut me down. I just decided to come on this platform. There's so many other people on this platform that don't have TikTok. So I'm just trying to, share the knowledge. So automatically what the IRS is trying to get you to understand is that their intent is talking to two or more people. So if you are running that business by yourself, you can see in this sentence, they're not even talking to you. I'm going to say it again. They're not even talking to you. Now, interestingly enough, when we see that the IRS automatically classifies a single member as a disregarded entity, the definition of disregarded is to pay no attention to or ignore. What the IRS is simply saying is, we do not pay attention to you as you and the business are two separate things. When you are a single member LLC, you and the business are seen as one. And I'm going to explain that in just a second. So whenever you go get an EIN number, the IRS is extremely clear on what it means to get an EIN number for an LLC or what it means to get an EIN number for anything else. Now, one of the things that I want to kind of get you all to understand in this very live is there's so much misinformation about business structures. You have situations where people saying, well, in order for you to become an S-Corp or a C-Corp, you have to make a certain amount of money. I am here to show you for yourself that is one of the biggest lies being told on social media. Because before you register that business, before you go get an EIN, the IRS is clear when they say before applying for an EIN, you should have determined what type of legal structure, business, or type of organization has been established, which means at no point is there an income requirement to select anything on this screen. You don't see not one place where it says, in order to be a sole proprietor, you got to make 5,000. In order to be a partnership, you got to make 10,000. In order for you to be a corporation, you got to make 20,000. You don't see that. So when people are telling you that you have to make a certain amount of money to become this or to become that, that's a lie. The IRS is under the assumption, excuse me. The IRS is under the assumption at this very moment that you didn't make any money. You didn't make no money yet. So why don't you tell me how you want me to treat you? You want me to treat you as a sole proprietor? You want me to treat you as a partnership? You see what I'm saying? So when you select limited liability company, here's what happens. The IRS says you have chosen. I'm going to stop. That means there's no one else's fault because you made this choice. You have chosen. You made a choice. Now, I know most people say, well, limited liability means that if something happens to my business, I won't be sued. You see, you have to understand what the definition of limited liability is. and I'm going to read it to you. So what I'm going to do real quick is I'm going to pull up the definition of limited liability. And I'm reading, if you can look at my screen, I'm reading from the dictionary, Barron's Dictionary of Legal Terms. And what I'm going to do is pull up the definition. If you can see it, I'm going to read you the definition of limited liability. I know it's a little blurry, so forgive me, but I'm going to read you the definition of limited liability. The definition of limited liability is the limitation placed on the amount an investor of a corporation can lose resulting from a lawsuit against the corporation or other loss suffered by the corporation. Automatically, what you now see is that limited liability was never for you. It was never for you. And then when we see the word company, we have to go back to the definition of company according to the legal term. You know, if you was expecting people to come visit you at your house, typically where I'm from in southern Louisiana called Lafayette, we would say we having company come over. That is to signify that there's more than one person. So whenever you look at the definition of company, I'm going to show you, I'm reading from the definition of company. It says a group of people organized to perform an activity, business, or industrial enterprise. What you can see is, again, it was never meant for just one. So now, when you understand that, this is where things are going to make sense for you. Number one, the IRS says a limited liability company is a structure. What it is, it says right here, you have chosen limited liability company. What it is, a limited liability company is a structure allowed by state statute. Okay. Again, it's not on federal statute, only state. An LLC is formed by filing articles of organization. Again, an article of organization, not incorporation. Now, if you scroll down after you read that you have chosen a limited liability company, what it is, the IRS also says what it is not. LLCs are not incorporated and they don't file in articles of incorporation. Now, here is where if I ask people right now, do you believe that the LLC is a legal separate entity? Most people would tell me yes. Most people would tell me, yes, I believe that if my business was sued as a single member LLC, my personal assets would be protected. That's a lie. If I went to get a business loan, they would always have to use my social security number. Why? Because LLCs are not incorporated. Well, Dwayne, what does it mean to be incorporated? It says it right here. A business is incorporated when it's been granted a charter legally recognizing it as a separate entity. So automatically, you think that you are operating something that's separate from you and it's not. So every decision that you have made ever since you opened this LLC was based on something that wasn't true to you. It was like you're thinking that it's doing something that it's not. And at this very moment, anything that you do outside of this, you're going to be treated as an entity that's not separated from you because LLCs are not incorporated. So now let me show you how you listen to so much stuff on social media, you don't even pay attention to the things that you see. If you go look at your EIN paperwork for your LLC, I would be willing to bet it has your company name, LLC, and your name on the paper. How can you look at your name being on a paper and still think that you're separated from that thing that has your name on it? How can it's not even logically possible? You are listening to so much stuff on social media telling you that you are, but you're ignoring what your eyes are showing. Your eyes are telling you your name is on this piece of paper. How in the world are you going to be separated from the business? You even double down. You put all your chips in with that same thinking, And then you go file your taxes. Here's what happens. Now, I'm going to share something with you. This is probably going to offend some people, and that's okay because the truth is still the truth. I'm going to explain this to you, and this is no offense to CPAs. This is no offense to accountants. This is no offense to bookkeepers. This is no offense to enrolled agents. I am simply telling you straight up and honestly. Typically, whenever you go ask a CPA, accountant, or enrolled agent, or anything about business advice, they're giving you advice based on from a financial and a tax perspective. They're not giving you information based on a holistic perspective. If you want to get a loan, are they going to tell you how to separate yourself from the business? You see what I'm saying? That they're not thinking like that, right? But let's go down this lane real quick. When you file your when you file your taxes on a 1040, this is called your individual income tax return. That's yours. That's your tax return. So logically, anything that you put on your tax return, you are responsible for. So whenever the IRS is asking you, tell me about the money that you made in the income section, line 1 says total amount from form W-2. That's your job. That's your 9 to 5. Whenever you work, you have taxes taken out your check and you get a W-2 at the end of the year. You place that amount on line 1. On line number 8 of your tax return, it says additional income from Schedule 1. All right. What additional income is the IRS asking us about? Let's go pull up the Schedule 1. So on the Schedule 1, any other money that we make, now here's where this is going to get good. It might go over some people's head, but it's going to get real good because you're going to now start to have what I call a light bulb moment. When you list any additional income, the IRS is saying, do you have any taxable refunds, credits, etc.? Do you receive alimony? Do you have business income or loss? Line 5 says rental real estate income, royalty income, partnership income. S-Corp income. Unemployment income, gambling, jury duty. What the IRS is simply saying is, tell me about any extra money you made. So whenever you are a single member LLC, you typically would put your income on a Schedule C. Now, all the while, you are walking around. If I ask you the name of your company, you would tell me your name of the company and you would end it with LLC. You wear that LLC like it's a badge of honor. Like you graduated, right? If I ask you what's the name of your company, tell me the name of your company. Don't tell me the structure of your company. But you wear it like a badge of honor. But here's what happens when you file your taxes. Schedule C. Now, all the while, you telling everybody and their mama, I am a LLC. But when you put your business income on a Schedule C, it says profit or loss from business, sole proprietorship. Uh-oh. Uh-oh. Huh. Well, what's the definition of a sole proprietor? I'm glad you asked. A sole proprietor is a person who is the exclusive owner of a business. That's you. By yourself. Who is entitled to keep all profits after tax has been paid, but liable, for all losses. Well, Dwayne, what's the definition of liable? Responsible by law, legally answerable. So if you tell the IRS that your business either had a profit or loss, the IRS is saying thank you. And if you own that business by yourself, you are a sole proprietor. Because before you can even tell the IRS the name of that company on line C or what type of business you're running on line A, at the very top it says, tell me the name of the proprietor. Tell me the name of the exclusive owner of this business. That's you. So you start to talk about the income that that business made or didn't. And all you know, expense, write off, write off, write off. I'll explain that later. But regardless, if you made money, which is a net profit, or the business lost money, you would have to place whatever that number is on line 31. It says place it on the Schedule 1, Form 1040, line 3. So we're going to go back to the Schedule 1 and place that number right here on line 3. And at the very bottom, or if you have S-Corp income, right, line 5. But at the very bottom of that, on line 10, it says combines lines 1 through 7 and 9 and add that to your 1040 on line number 8. Now, I'm not going to use the word common sense. I'm just going to use the word, let's use logic for a second. Whenever I place that business income on line 8 of my 1040, on line 9 of my 1040, it says add lines 1, 2, 3, 4, 5, 6, 7, and 8. This is your total income. Now ask yourself this question. How can you be separated from something that you just claimed as your individual income? So when the bank is asking you, sir, ma'am, show me the paperwork for your business, you gave them a business EIN document with your name on it. The bank says, show me about the business income. You gave them your individual income tax return. So when they ask you to personally guarantee it, they're only going by what you have showed the IRS. And at this very moment, this is where people start to realize maybe this ain't what I thought it was, right? And it's true. Maybe this is, you're thinking that it's doing something for you, sorry, that it's not. Because when you take financial responsibility, hey, whenever you take financial responsibility for something, how can you be separated from it? It logically doesn't make sense. Now, if I asked you, well, Dwayne, how do I separate myself from the business? Let me share something with you. According to the Internal Revenue Service, you thought this whole time that a corporation was this big 60-story foot building with 15,000 employees, and that's a lie. According to the Internal Revenue Service, whenever the term United States person is ever used, it says a citizen or resident, that's you, that's me, a partnership or a corporation. Now, let me talk about this partnership now. Pay attention. This might hit you like a ton of bricks. Let me go back to that tax return. You see, when you married, when you file your individual tax return, it's funny how your first name, last name, plus if it's a joint return, your spouse name and last name. It's funny how two people is seen as an individual. It's funny how this partnership is seen as one. But whenever you understand that anytime that the IRS uses the term United States person, they're simply talking about a corporation. And if you don't believe me, let's go back to the EIN document. We're going to go get an EIN. And we're going to select corporation. Look what the IRS says. A corporation is a person. At no point does this say a corporation is a building. At no point does it say a corporation is 15,000 employees. At no point does it say a corporation is something that makes X amount of dollars every year. It doesn't say that. It says it's a person. So if you want the business to be separated from you, that business has to be its own person. Period. And I know, watch this. You ready? You go ask your CPA, your bookkeeper, your accountant, and the first thing that some of them might say is, well, you have to pay double tax. I say, again, you see how they're only concerned about the tax? And they never explain how much the tax is. But they're only concerned about the tax. You file taxes once a year. You operate your business 12 months out the year. Surely you didn't open a business to just be concerned about taxes. I'm not saying that it's not important. It's just that if you're going to explain double taxation, you might as well talk about how much the tax is. If you're going to give somebody some information, give it all to them, right? But again, if you want your business to be separated, it has to be a person. Now, let me explain what that means to you. Here we go. I'm going to go back to the business structures. And I'm going to click corporation. A corporation can also take special deductions for federal income tax purposes. A C corporation is recognized as a separate tax-paying entity because it's a person, right? Well, the profits of a corporation is taxed when earned. Okay, here's what happens. Let's just use this as an example. Let's say you work for Walmart. If Walmart paid you $40,000, you would have to pay taxes. If Walmart made money, Walmart have to pay taxes. When people explaining double taxation to you, they're not telling you that you're also the owner and the employee. That's it. If you want your business to be a separate entity, you can't have it both ways. You can't say don't tax me twice. You can't say that. If the business makes money, it pays taxes. If the business pays you, you pay taxes. The problem is no one is explaining to you how much the tax is. And I'm explaining to you right here. For the sake of this conversation, we're going to use $40,000 as an example. The federal tax bracket starts at 10%, and it goes all the way to 37%. That means that no matter who you are, when you receive income, you fall between 10% and 37%. So for the sake of the conversation, we're going to talk about $40,000. As a self-employed individual, you have that LLC by yourself. Let me show you what happens. Now, this is going to be a heavy conversation, but I want you to follow along. On $40,000, you would pay 12% in federal taxes. Well, just because you work for yourself, that doesn't make you exempt from what other employees pay. You see, because every time an employee receives a paycheck, they have federal, Social Security, and Medicare taxes taken out of their check. It is what it is. So as a single member LLC, if you make $40,000, you're going to pay 12% in federal taxes. Well, because you also have to pay Social Security and Medicare, that's an additional 15.3%. Now, here is where, now I want y'all to be, and I feel where I'm going. This is usually the point where people say, well, how can I avoid paying self-employment tax? All right. A self-employed individual, you got 12% federal plus 15.3% on Social Security and Medicare. That's 27.3%. Here is where people try to go, quote unquote, the S-Corp route. You see, what most people don't understand is whenever you register your business as an LLC and you elect to have your business taxed as an S-Corp, two things happen. Number one, just because you have your taxes filed as an S-Corp, according to the state that you operate in, you are still an LLC. You will never log on to a Secretary of State and it'll say S-Corp. It doesn't work. You're still an LLC. Ain't that something? But typically when people go to S-Corp route, it's because they say, well, we don't have to pay the 15.3% in self-employment. Now, let me break that down for you. You see, whenever you work at Walmart, McDonald's, or whatever the case is, your regular job takes federal taxes, Social Security, Medicare taxes taken out. Surely they don't take out 15.3%. You know why? Because you as an employee pays half and your employer pays the other half. Now, interestingly enough, sure, S-Corps don't pay self-employment tax. You know why? Because whenever you file your taxes as an S-Corp, that means you have to be an employee of the company. Guess what happens? Whenever you get paid, you are going to pay half. Never mind. I'll let that sink in for all of those, people that have a PhD in LLCs. I'll let that sink in just a second. Let me go back over here. So let's talk about the corporation. The profits of a corporation is taxed when earned. Well, how much is the corporate tax rate? You ready? A corporation pays 21% flat. And then it says the profits of a corporation is taxed to the corporation, and then it is taxed to the shareholders when distributed as a dividend. Oh. Huh. This is strange. This creates double taxation. Of course it does. But there's a such thing as a qualified dividend. That means that if the company pays you and you let that money sit for like 62 days, it becomes qualified, not ordinary. Ordinary dividends fall in the tax bracket of 10% to 37%. But a qualified dividend, that means whenever the company pays you, you let it sit for a minute. What's that tax rate? Now, first of all, you have to understand that qualified dividends are taxed at 0 and ends at 20. The fact that qualified dividends start at 0, that means somebody qualified. But who qualifies? If you're single and you make less than $47,000, you pay 0 in tax. If you're married and you get paid $94,000 or less, you pay 0 in tax. See, most people get very frustrated with wealthy people and why they don't pay taxes because they understand. Why would I go on record? Ask yourself this question. If you have everything that you need, why would you go on record to show that you're making more than 47,000? Why? Who are you trying to impress? The IRS? That doesn't make sense. If you're married, if you have a house, you have your car, why are you going on record to show that you're making more than $94,000? For what? There is no award. There's no certificate. It's not. That means that you're probably doing it because of ego, pride. You don't go around sharing your tax returns with people that you know. So what you doing it for? Okay, let me get to the meat and potatoes. And this is where this conversation is stemming from. I try to educate people on what it means to build a legacy. Now, I want y'all to understand. Let me say this first. The definition of ignorance is lacking knowledge or information. Most business owners are ignorant. I know. It sounds a little harsh when you say it, but it doesn't take away from the truth. Most business owners are ignorant. Here is why. You were taught how to be a student. You were taught how to be an employee. In fact, when you started a job, they probably trained you on how to help somebody else live the dream you desire. No one teaches you how to be a business owner. You probably got your LLC because somebody told you. No one is teaching you how to be a business owner. So that means you are lacking knowledge and information that makes you ignorant. And if it makes you feel a certain type of way by me calling you ignorant, change it. Don't be ignorant anymore. Right? And here's why I say that. And I want you to understand. Where am I going? Right here. If the Internal Revenue Service says a person is a corporation, when you see this screen, all you see is people. People. They're all different people too. Your operating company, your parent company, your real estate investment trust, let me explain all that to you. Your operating company, let's call it ABC Lemonade. ABC Lemonade sells lemonade on the weekends. Every Saturday, every Sunday, you're on the corner selling lemonade and you advertise the lemonade as ABC Lemonade. Well, the parent company is ABC Lemonade Incorporated. They own the name ABC Lemonade. If they want to charge you a fee for using ABC Lemonade, they can. Why? Because you're renting the name. You're borrowing the name. It's called a naming right. You want me to tell you who else does this in this exact same fashion? Chick-fil-A, McDonald's, Smoothie King. You know, when you franchise businesses, that's what they do. You have to pay to use their name. This is the same concept. Your real estate investment trust is nothing more than a property management company, a landlord. So if your ABC Lemonade Incorporated company, your parent company, rents an office building, well, who owned the office building? Sugar Property Management Company. It's a different company. And if Sugar Property Management Company is owned by a holding company called Refresh Holdings, as you can see, these are all four different people doing four different things. If they do business to business with one another, there's no law being broken. There's none. So in this illustration, what you will see is me trying to explain how you can change your life just by letting other people do what they do. Let me explain. On the screen, what you're going to see is a definition called business to business transaction, B2B. A business to business transaction is a commercial transaction between two businesses, nothing more, nothing less. Don't overthink it. When you go buy bread out of Walmart, Walmart did a business to business transaction between Walmart and the bread company. Two separate companies, two different things. Again, all four different things doing four different business transactions. Each of them have their own bank account. Each of them have their own EIN number. They're all four different people. Another word that I want to introduce you to, for those that don't know, what is accounts receivables? Accounts receivables is the amount of money that customers owe a company for products or services that have been delivered but not yet paid for. In other words, let's just say that you went rent an apartment complex. You went rent an apartment. The apartment charges you $1,000 a month in rent. You sign a year lease. On the accounts receivables line of the balance sheet for that apartment complex, it would say $12,000. Why? Because that's what you owe them. There are financial institutions right now, credit card processing companies right now, that would give you a loan just based on you having accounts receivables. You have people that owe you money, so they're going to let you borrow. Nothing more, nothing less. So in order for you to quote unquote leave a legacy for your family, you got to build it. And what I'm trying to show you is this is how you build it. This is how you fund it. This is how you grow it. If you have a lemonade company, a parent company, a property management company, and a holding company, how can you make all of this work between all four of these companies? Easy. You deposit $1,000 into the operating company account. $1,000. That's it. Nothing more, nothing less. You deposit $1,000 cash. I don't care if you got it from selling food stamps. I don't care if you got it from gambling. Who cares where you got the $1,000 from? Excuse me. You deposit $1,000 cash into ABC Lemonade, right? The parent company sends an invoice for $1,000. Why? Because the parent company says, look, I own the name ABC Lemonade and you're using it. I'm going to charge you. ABC Lemonade Incorporated, their address is 123 Happy Street. Well, who owns 123 Happy Street? Sugar Property Management. So ABC Lemonade receives an invoice from Sugar Property Management for how much? $1,000. So now Sugar has the $1,000. All of a sudden, Sugar gets an invoice from Refresh Holdings. Why? Refresh Holdings says, look, since I'm responsible for holding all of your assets, I'm going to charge you $1,000. And then all of a sudden, Refresh Holdings gets an invoice from who? ABC Lemonade at the bottom. Why? ABC Lemonade says, look, since I introduced all three of y'all together, I want a finder's fee for $1,000. So what you have seen done is you took a $1,000 cash deposit and now showed that each company had a $1,000 invoice. Now, here is where a question came in. When rotating, does it matter about the number of customers or is it just about the amount of money that's being processed? A mixture of both, Key. A mixture of both. The money is more important, but Stripe does take into consideration the number of customers, right? This is why, I'm giving you kind of like a base. So here's where typically people would ask the question, well, Dwayne, you ready? What about the tax implication? Now, I'm going to explain this in further detail, but for those who are thinking about how you're going to pay taxes on all that, let me show you something. Hello. You are so used to thinking like an employee. Here's what happens. You have been conditioned for years. As an employee, you get your paycheck. Taxes are taken out. And you have to live off of what's left. You have been doing this same repetitive cycle ever since you had a job. And all you think about is taxes. Corporations don't work like that. You see, corporations, when they get money, they have to pay their bills first and then pay taxes on what's left. So if the company received 1,000 and paid out 1,000, what's the tax? I know this is heavy. So when you take $1,000 and deposit it into the operating company, and then all of a sudden you show that each company had $1,000 invoice that was paid and they received $1,000, let me share something with you. Don't go nowhere. Let me share something with you. Don't go nowhere. Eyes are coming. I'm logging into a payment processing company called Stripe. I'm logging in. And I'm going first show you something that two things. Because you open a payment processing account with Stripe, whenever you go try to get funding from Stripe, Stripe says applying for financing through Stripe doesn't require a personal credit check. And I'm going to explain why. Additionally, Stripe Capital reports the performance for U.S. business to the Small Business Financial Exchange. That means you're building business credit at the same time. So let me explain that to you. What you can see, if you look at my screen, I'm pulling up, this is my wallet, right? Consider this wallet a payment terminal. No, I'm coming, Jamal. Hold on. A payment terminal. What do I mean? This is a debit card. If I went to Walmart right now and I get to the checkout counter, the self checkout, after I'm finished scanning all of my documents, Walmart has a terminal that you slide your debit card in that processes the payment. Stripe is a payment processor. It's just the terminal. And what Stripe is saying is, I am monitoring all of the transactions that come in. And based on the amount of money that you process through my company, I'm going to give you a loan. Generally for half of what you typically process. So you remember when I gave you the definition of accounts receivables? Accounts receivables is the amount of money that a customer's owe for product or services, but you never been paid for yet. What Stripe is basically saying is, I'm going to monitor your transactions for 6 months. And based on what I see in 6 months, I'm going to assume you're going to do the same amount of transactions the next 6 months. So what am I saying? If you took $1,000, let me pull up my calculator because I want y'all to see it. I know some people are visual learners. Pull up the calculator on the screen for y'all. If you took $1,000 and invoiced each company, making it bigger for you. If you took $1,000 and invoiced each company 4 times a month, that's $4,000 each company. When you multiply that times 12, again, we are creating the accounts receivables in your mind. Because basically, if you rotate, if you do $4,000 a month of transactions consistently for 6 to 9 months, Stripe is going to assume that's what you're going to be doing for the year. When you take $4,000 and you multiply that times 12, Stripe says, I am thinking that you're going to do about $48,000 of revenue. And because you've been consistent for 6 months and all the analytics are showing that you're on track to do $48,000 a year, Stripe is saying, I'm going to give you a loan for half of that, which is $24,000. Now, when you really look at it from a holistic perspective, Stripe is really telling you, when you do that 4 times a month and each company can get $24,000 in a loan, that's $96,000 in funding that you just secured without ever having to use in your credit. Because why? You set up a corporate account. The problem isn't getting you money for your business. The problem is you're always thinking like an employee and don't understand how business works. So one comment came in, says it should be a write-off. And here is where I have to get everybody to stop thinking like an employee, because words have meaning, words have power. Whenever you open a business, your business is an asset. Assets make you money. Liabilities cost you money. So if your business is an asset, typically when you keep using words, and again, Jamal, I'm not fussing with you. I'm just showing. Typically when people use words like write-off, look what they're saying. Look at what you're saying about your business. The definition of write-off is to dismiss someone or something as insignificant. It's to cancel the record of a bad debt, or watch, acknowledge the loss of or failure to recover an asset. Your business is an asset. When you have people out there that identify themselves as a small business owner, the definition of small is of a size less than normal or usual, insignificant or unimportant. The real question becomes, Dwayne, if an asset makes you money and a liability costs you money, how can I reduce my tax liability? How can I reduce how much I owe in taxes? Well, I'm glad you asked. You see, if you look at this screen real close, you're going to see how I have the holding company, the real estate investment trust, the parent company, the operating company, all connected together. But I got that nonprofit sitting on the side. Well, Dwayne, why do you have that nonprofit sitting on the side? See, because we need that nonprofit to be seen as something totally separate away from us. Why? You see, because here's what the IRS says. The IRS says on their website, in most cases, the amount of charitable cash contributions taxpayers can deduct on a Schedule A as an itemized deduction is limited to a percentage of 60% of the taxpayer's adjusted gross income. Dwayne, what the hell are you saying? That's too much jargon. What I'm basically saying is the IRS allows typically people to donate up to 60% of their money to charity. But remember when I told y'all about qualified dividends? Here's what the IRS says about qualified. It's funny. Don't be limited, y'all. Be qualified. Here's what the IRS says about qualified contributions. Qualified contributions are not subject to these limitations. To this limitation. That means an individual may deduct qualified contributions of up to 100% of their adjusted gross income. In other words, what that's saying is, and you can take all of your money and donate it to charity. But in order for it to be a qualified contribution, it has to be made to a qualified organization. Dwayne, what's a qualified organization? You ready? A community chest, a corporation, a trust, a fund, or a foundation. Not one place do you see an LLC. So whenever you see people donate money with a big white check on the screen, you think that they're donating to a cause. They are theirs. Now, I know what you're thinking. Well, Dwayne, if I donate all my money to charity, how am I getting my money out? See how you keep thinking about yourself? But I'm going to help you anyway. What most people don't understand is IKEA is one of the largest furniture stores in the world. IKEA is a nonprofit organization. Did you know that? So what am I saying? I'm saying if you donated all your money to charity, but your nonprofit organization hired, your tax office, hired your consulting firm, hired your landscaping company, hired your trucking company, hired this and hired that to do work. I'll let that sink in for a second. Now, I know this is going to be delayed, but does anybody have any questions? I know I've probably given you a lot of information. I understand it. And I'm going to go check over yonder to see if any questions came in. All right. We good on Instagram over here. I'm just pausing to see if anybody have any questions. I'm paused for about 20 seconds. If you have any questions, just type them in. There's a delay on my end, so just bear with me. All right, no questions. So should I change the rotation of the companies to show multiple customers? Your businesses, all those different businesses are multiple customers. Remember, each business is seen as a customer. Each business is seen as a customer. So I got a message from Instagram. So Instagram, you all will probably be cut off in the next 4 minutes. Instagram only allows, I guess, maybe an hour to stream. So you will be cut off. Um, I can't control it. That's what StreamYard just sent a message saying. So if you're cut off, please visit my website. If you have any questions, you want to schedule a consultation, let me go and pull up how to reach me really quick. My website, now typically my websites are in the links of my bios. But for those who, want it, here's my website where you can schedule a consultation and all that good stuff. So typically people ask me, Dwayne, how can I learn all of this information? And this is where, if I go to my website, I have a number of different ways that people can learn this stuff. On my website, underneath if you hover over the services, you're going to see the word that says masterclass. I do have a class that teaches people all of this stuff. Now, two things that you need to understand. Number one, on my website, it shows that the value is $15.99 for a limited time and $6.99. But if you click the enroll button now, it's $499. What is the name of the company that you utilize to get your corporate lease? I go through my attorney's office. So I have a class that teaches people all of this stuff. It's a 6 courses that's self-paced. Each class is about an hour and a half long. And I also provide ebooks to help. I also do 2 trainings every month. 2 trainings every month. It's almost like going to business owner school for $20 a month. College degrees cost more than that, right? And this is where I teach you about automation and things of that nature. So you under the services tab, you would click the Momentum membership program. And then last but not least, if people need help setting up this legacy builder where they can start rotating money, on my website, other services, click Legacy Builder. What you will see is I will open all of those businesses for you, get you your articles of incorporation, get you your EIN numbers, your bylaws, and things of that nature. And if you want me to do it with a nonprofit, then submit your 501c3 application. It's $34.99. If you don't want the nonprofit, it's $29.99. And what I've been doing lately is for people who purchase a Legacy Builder, I've been giving you that masterclass for free. I'm gonna write you a business plan for free. I give you access to a year's worth of training twice a month for free. And because I would open a holding company in Wyoming for you, Wyoming doesn't have any individual income tax, nor does Wyoming have a corporate tax. In order for you to take advantage of that tax, those tax incentives rather, you have to be a resident of Wyoming. And I know that you're not going to move to Wyoming. So one way that we establish residency is to have you have a lease. So I would get you a commercial lease in Wyoming for a year for free. Also, one of the questions that came in also, are there specific days of the month that you go live twice a month? So I go live just randomly. I do classes twice a month at 7 p.m. Central. For my members only. It's a private class. But all of the classes that I do for that members group is 100%. They're all recorded, so you always have access to them. So I typically go live. I've been going live a lot on TikTok. I have a lot of followers on TikTok. But I did say that I wanted to start doing more live presentations on YouTube, more live presentations on Facebook and stuff like that. So this is me just kind of just starting the process to kind of make sure that I reach people that don't necessarily have TikTok platforms. So it's just random, to be honest with you. I did send out a post on social media to let people know I will be going live at 8 a.m. this morning. So yeah, so the classes is definitely twice a month. Is on a Tuesday. So we start with the second Tuesday of the month, and then right after that, the like 2 weeks after that. So 2 Tuesdays a month, 7 p.m. Central. They're all going to be recorded, and we send out a Google Meet link the week before, a couple of days before, so that way, because again, it's a private class. Hopefully that helps. Absolutely. So nevertheless, I do thank everyone for their time. I do appreciate you all joining in. If you have any questions, feel free to reach out to me. I'm always available. If not me, my team. I only have one uh, TikTok account under Dwayne underscore the Mac. I probably have about 16 fake pages. I do have a couple fake pages on Facebook that I've also reported. Um, this is this is my only Dwayne underscore the Mac on pretty much all platforms outside of Facebook. Facebook is just Dwayne Williams, and then in parentheses it'll say twin on the side. But this is how you would typically reach me, and on Instagram. So make sure that you tap into all social media platforms, because you just never know. I'm always doing something different. Just make sure that you turn on your notifications, and make sure that you definitely subscribe to the YouTube channel as well, because there's a lot of videos posted on the YouTube channel as well. So with that being said, I do appreciate everybody's time. I hope this was very helpful and insightful, and hopefully give you some new perspective on how you can actually change your life. With that being said, you all have an amazing day. Thank you.